And welcome back to Dukascopy TV. We're joined in the studio once again by Sergio Rivera, and we're talking investing in Europe. Sergio, thank you so much for joining us once again.
Thank you, Jennifer. It's a pleasure to be here.
Now, first of all, we can't not talk about the latest news out of Europe and about Greece. This latest aid packet for the country, trying to reduce the country's debt by 40 billion euros. Now, has this changed the way investors are looking at European stocks, bonds, and indeed the euro itself?
Well, last time I checked the screens, the markets were up today, but that really doesn't mean anything. I think you have to go away from the daily news flow and right now the very happy talk about having found a solution for Greece. What the Euro countries did is just to agree on a series of measures that, first of all, need to be ratified at a later stage, and that will only provide some additional financing to Greece. I don't think that we're talking about a grand bargain for all peripheral Europe. Certainly this will alleviate Greece's needs in the short term, but I would say that many problems remain. So I would remain very cautious about Europe.
I see. And what about the US and the US dollar? Are you optimistic for that?
So I would be cautiously optimistic. Things are improving. The housing market is not what it used to be. It only represents about 2.5% of US GDP. So even if it improved dramatically in terms of GDP growth, it would have a small impact. But more important than that, it is the impact on investor psychology and on what companies who are swimming in cash. US companies have well in excess of $2 trillion to put to work. Once confidence improves and the US consumer and the US entrepreneur feel that now they have a clear road ahead, I would say chances are that the US economy will improve, and with it the dollar as well.
I see. So you're a bit more cautious towards Europe, a little bit more optimistic towards the US. But what about China and other emerging markets?
Well, everybody has heard the acronym, which is now about 10 years old, the BRIC acronym, referring to Brazil, Russia, India, China. Later on, it was made larger to BRICS, to include South Africa. And I feel much more optimistic about the short, medium, and long-term prospects of these countries. If you add countries like Turkey, Mexico, Indonesia, and a few other Asian powers, what has been branded now as the Eagles, which are the emerging and growth list of countries. For that group of Eagles, I feel very strongly that time, demographics, and the recent economic developments are on their side. I would say that most of these countries are going away from an export-led model towards looking more at their own consumer basis and the emergence of a middle class. So there are tens of millions of people added to the emerging classes in China. The same has been the case for Russia, Brazil, Mexico is seeing its middle class grow as well. So I would say that selling to those countries and selling to the emerging consumer will produce very interesting results, and investing in companies that do just that.
I see. So Sergio, give us some advice on investments. Would you rather invest in, say, a country that's very rich but getting poorer, or in fact the opposite of a poor country that's looking to develop?
I think you've put just the finger on the most important question, Jennifer. We are very familiar with developed countries, with the US, the European countries, countries like Japan. But unfortunately, the demographic structure of these countries tell us that in the years to come, there will be more people reaching retirement age without necessarily the support structure to make them a rich consumer. Whereas in emerging countries, you have the opposite. You have an ample sector of the population in working age, a small, relatively small segment of the population in retirement age, and these productive consumers who have high aspirations, I think, will provide a much more fertile field to invest in. So yes, invest in less rich countries becoming richer.
Oh, I see. Well, Sergio, thank you so much. But just before you go, a little bit more advice for our viewers. I've just got the Dukascopy question to ask you, and we ask every guest that comes into the studio, if you had $1 million to invest in the market for just 1 year, where would you put it and why? So let's take a look at your options.
Without question, I would invest in equities. And preferably emerging market equities.
Sergio, thank you so much for coming in once again. It's always a pleasure to have you in the Dukascopy studio. Thank
you, Jennifer. It's been a pleasure to be here.
That's all from us here in the studio, but just click back to the website for more interviews and updates. Goodbye.